So I'll start with the caveat that we had never been big investors in IT services because we felt that this is really not a platform play, right? It's, so there are businesses where economies of scale can be hugely beneficial. In services, you don't get that, right? So what you want to see in the platform business is the great thing is that each piece of incremental business beyond a critical mass doesn't add to your cost. And that results in accelerated return on equity and capital. That doesn't happen in services. And so with that bias in mind, I would say in the early stages, we did look at this space. We did make some investments. Happiest Minds was sort of the most important one that comes to mind in that phase. But it may be the case that the trend has run. If you look at IT services over very long term in India, right, it has sort of followed the cyclical pattern. While there should not be much of a cyclicality to the business, but if you look at the valuations, they've always followed that cyclical pattern. And that's because the growth beyond a certain level becomes difficult. I think in the last 1.5 years, people have seen how much dependence the world has on technology. And as a result, the need for IT services is sort of in your face. But the level of growth that you would see there is still limited, right? And it doesn't lead to that accelerated return on capital. And I'm sure people are able to find good ideas in that space, but we find that there are other places where we can get better return on our investment. So we've not been focusing on that.
What about the other technology pieces then? There is, again, this whole debate about whether it makes sense to bet on the path to profitability versus buying an entrenched player, because profitability will come as it came maybe for Amazon, maybe for some of the others. Help us understand your thinking behind the new age consumer tech companies or whatever, fintech, what have you.
Got it. So, we do believe that in businesses which are winner takes all and where there's a clear winner, it's incumbent upon that winner to keep expanding the market and to become more and more entrenched. And if that results in sort of higher deployment of capital up front, then that's a rational thing to do, right? But all of that starts on that big premise up front. Is this a winner take all? And is the company you're betting is really the winner? If the answer to those two questions is correct, and yes, then you could perhaps take the path of saying that you can defer the profitability for longer. But in vast majority of the cases, the answer to those two questions is not a yes, right? And then it just becomes an easy excuse to invest in companies that don't really have a path to profitability and to justify a higher valuation. So I would say that in our case, our overwhelming preference has been to invest in companies that have clearly demonstrated profitability. And yes, we know that we're missing out on certain opportunities as a result, but that conservative approach has done extremely well for us, right? So, the two tech examples that I mentioned to you, Apple and IndiaMart, they both have been highly profitable businesses, and yet they've been able to deliver, growth which is far above what the overall market is delivering, and many technology companies are delivering, right?